Hello and welcome back to today's episode of Crypt. Oh my God, I'm covering a really fun article that just came out from A16Z's legal head. This is talking about the end of the foundation era. I'm just going to hop right into it. Now, one thing to note is that as we've built out these structures for these decentralized semi-autonomous systems, there's been a really difficult sort of middle ground, which is the legal operational structuring. And especially when you get into how you actually have to build these things so that you can raise money, do the private sales of the token, it all becomes nuts. And what we've been left with is this pretty standardized methodology where you create a foreign foundation that is the thing that is really operating the launch of the product. This is completely separate from the developing company, from the people that are building it, from the company that raises money, but eventually it's going to be the governance that sort of wraps around the DAO and decides how the thing is going to operate. Now, in an ideal world, these foundations would be present for the fundraise, for the initial launch, and ultimately would disappear or would just sort of dissolve over time to go onto on-chain governance and voting. However, we found a lot of issues with this. It's been a huge, costly thing up front, first and foremost. Projects can spend up to $500,000 just to get these foundations set up, again, to raise and accept private capital. So straight out of the gate, if you're looking to launch one of these decentralized networks and you want to sell a token around it, I mean, you need $500,000 just straight into legal fees before you can get started on anything else. And that is nuts. That defeats the entire purpose of a lot of what has been going on in this industry. Now, A16Z, Andreessen Horowitz, they came out with this excellent piece, The End of the Foundation Era in Crypto, talking about how now, with the new SEC guidance, with really the market structure bill, which is going through Congress, is about to open up better opportunities, not only for the chains themselves, for moving towards decentralization and having a DAO that governs and oversees things, but also for the token holders to have a little bit more clarity into what's going on in those operational standards, as well as to maybe even have some protections legally speaking, because as of now, it doesn't fully exist. Let me quickly hop into what a standard structuring looks like from the Cayman and the BVI. And I know a lot of people tune into this and they're like, crypto, Graham, administration, all this stuff. This is what founders have to go through. They start as tech developers. They want to build the code. And in my experience, they often get disappointed and frustrated when they have to jump through these hoops and they realize how terrible the legal structuring is and how that impacts them actually. They also get miffed on the fundraising, on the ICO, but hell, these are the products that you're bringing to market. When you're doing these things, they are each their own independent product. So let's just hop in here. I've created this from my experience of launching these things around what is being called Company X. Now, let's say you're developing an app or a product and you want to launch a blockchain. This is going to be where that $500,000 is quickly going to disappear to. So we're calling it Company X, and everything going on here in this green center part is basically a Cayman foundation. It's really balanced between Cayman, BVI, Panama. Panama has an opportunity where this whole thing actually vanishes after the fundraising, which is like a crazy idea. But in a world where are these securities, are they not, in that opaque land of the SEC, it became extremely important to build this weird web of corporations, of entities that all facilitate a different part. A lot of this, keep in mind, is around tax advantage because, you're going to launch a token that, well, if you pre-mined it at zero, that could be a zero tax obligation. But if you happen to have a price attached to this token, like you sold it for X dollars or cents, and then it goes out public and suddenly a large chunk of these tokens comes into your company's purview, you owe taxes on that. So the BVI has great tax treatment. The Cayman has a better foundational structure for building a DAO, and it all gets super confusing and quite insane. So let's say Company X starts in America, right? The United States. Now, Company X launches a subsequent company. This could maybe be necessary, maybe not. Like if you're in the US, these two could be the same. If you're outside the US, this might be the external company. Either way, you're starting with a Delaware C Corp, a classic company. And of course, at the bottom, you have Company X, and maybe the development company is the same, maybe not. And they build the app, and the app has the tokens. Let's say the app is a chain, whatever it is. Now, token development privileges, they all have these weird relationships. But if you want to decentralize this, if you eventually want to say, hey, company X is going to launch this project, and obviously we're centralized at the moment, but we want to pass on that ownership, and we do not want it to be this US company. If it was a US company, the SEC could come after you, they could sue you to oblivion, they could shut you down. So you create this foundation, and the goal of this Cayman Foundation is to manage the governance, is to oversee the on-chain voting. Realistically, the votes should happen on-chain, and the foundation has to do whatever it can. However, you have to staff these things legally, so there's going to be somebody in there. Are they making money? Are they getting paid? Are they doing anything to benefit the org itself, or are they really just a placeholder for the seat? And this all gets so weird. So the foundation sits at the top. Then they create a sub-foundation, which is where the technical holdings, really the IP, is being held. And the DevCo, the development company, will build this IP, and they will basically say that this tech holding company has the rights and the access to that IP. Now, Company X has a holding limited in the BVI, which is going to be used solely for the purpose of raising money. So you have the foundation sitting at the top, really there to enforce anything from a DAO. Then they have access to a holding company that basically has rights to the IP and the tech being built by potentially this US company. And they also extend those to a BVI holding company, which has the right to issue SAFs, do the private sale, and basically go out to token buyers and say, hey, we're raising money. Now, all this money will flow back up to the foundation, and that is where it will be held. Of course, we've also got these weird obligations. So you have a foundation head, an actual person who needs to sit in this company. They are attached to an offshore limited liability company, which means that they can do marketing. They can basically advertise to some degree, whatever that's possible. And of course, they're also running the exchange accounts. So these all kind of sit inside this grandiose stack. The green is what the foundation truly is. And it's a series of 3 companies that own the IP, that can execute the DAO votes, and can also manage some of the capital, whether that be raising private capital accounts or handling some of the exchange trading, right? Eventually they get team tokens. They need to unload these. They need to sell these in order to pay this foundation head who's not really doing anything, but just kind of hanging out. And as you can see, all of this is just kind of wild, right? The app has a relationship with the holdings company, which really just gives them privileges to use the token, right? This BVI holding company is where the tokens live, so the tokens can work in the app. And of course, the IP to build the app is going to this Cayman Holdings one, and there's marketing breakup. And anyway, you can see how wild it is. And all of these are independent companies. They cost money to set up. They cost money every year to maintain. And of course, you end up with this foundation head up here who's maybe not really incentivized to do too much, right? He's really supposed to execute the votes of the DAO, but at the same time is receiving tokens to offload. So there's sell-side pressure. You got to pay this dude's salary. So that's also sell-side pressure. And just look at it. It's all really, really crazy. And what it comes down to is that you initially thought of yourself launching a crypto company or a product as this little US Delaware C Corp. Any independent business can be a Delaware C Corp, a small, medium-sized business, so on and so forth. And you're like, we're going to build an app, we're going to launch it, it's going to have a token. That's the through line. And you have a team and they can all talk on Slack. Then you get into the capital raise. You've got to create this litany of confusing companies. And can these guys be in your Slack? Probably not. Can they have direct communications with your developers and your apps? Probably not. But at the same time, they're the ones raising the money. They're the ones that have access to the team tokens. And they also have access to the market making accounts, right? Here on Coinbase or whatever, Binance, the markets that you're in. There's also marketing. So anyone developing things for the project itself probably can't market it. And you've got to create these what are called Chinese walls between the orgs. They're really not allowed to engage with each other. In fact, inside of the holdings company in the BVI, or even one in the Caymans, there might be a different board of directors that if, let's say, you want to make an execution like selling tokens, you might have to get approval from that board. Now, they're your tokens, they're your money. So it's not like the most aggressive approval, but they are their own independent entities. They do have to self-report. They have to be compliant. So they need to be able to pass this through in a legitimate way. Suffice it to say, this is all really crazy. And I have watched so many founders go through this time and time again. Of course, they raise a little bit of money, or they at least have the desire and intent to raise money. Then the investors say, well, where are we giving that money to? And shit, if you don't have this whole structure set up, you can't take that money. Not only does it break down your organizational flow, but it fucks up all of your comms and it makes it all very large and confusing. You can see that this is a whole education in and of itself, something to heavily distract the CEO while he's trying to build and launch good technology. What we have here is the new market structures bill, and this is going to open up a lot of clarity and potentiality around how we can launch and maintain maybe a decentralized org inside of the US. One of the biggest things about this is that this whole web of crazy companies sort of deflects blame, right? Blame goes here, not 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 goes here. Where does the blame sit? So there isn't really a lot of liability built into this. In fact, that's kind of the idea, is that if the regulators come after you, you can kind of give them all of these punching bag companies before they get to anything of substance, and basically saying, hey, these guys raised all the money, just beat the shit out of them. But these guys have all the IP. And in fact, the IP doesn't sit with the development company. I mean, guys, it's so maniacal. So what is happening with the market structure bill is a way to say, hey, what if you just launched a Delaware C Corp? And on top of that, you issued some of these new structures being proposed that allow you to operate as a DAO, as whatever sort of decentralized entity you want to do. And with a Delaware C Corp and all the protections that come with the great United States system of law, the people in the corp actually inherit some fiduciary liability, some responsibility. And honestly, in this big Cayman sandwich structure, there's no way for an investor that's been wronged to seek recompense. They can't chase it down. It's just too spread out. And this new idea coming from the bill is basically putting up a lot of ways that you can do this from a more common structure that is better protected under US law. So this not only benefits the projects themselves, it aligns them, it allows them all to be in the same Slack, it allows better communication, better execution from less companies. You just simply don't have to juggle this wild chart to just execute better, to be way cheaper. Remember, a Delaware C Corp on LegalZoom is like $2,000 in 10 minutes. So this is a giant step away from the $500,000 fee structure. Now, this A16Z post, obviously A16Z is at the bleeding edge of everything around the tech to the investments. They're investors. They're working with these founders. They're seeing a lot of venture capital just going and being burned into legal fees, largely because the SEC was so opaque and they didn't let us know what was happening. But this is a really quick and pretty easy read. It goes on to talk about why foundations were necessary, and really it was to add confusion to the mix, to be honest with you. But that confusion was in an effort to pursue decentralization. Now, one of the worst things that happened was that the foundations don't really enhance executability, right? That same thing about being in different Slacks, just being split, having these Chinese walls between them, that does not help an org execute, right? It doesn't come together and get a vision and go out and chase it. So while we were pursuing decentralization, we actually ended up getting stuck with these stupid foundation heads. They had to be there. They were obliged to be there to maintain compliance. But we often found that instead of going fully decentralized, founders had gone through all these hoops. They spent all this money to build a foundation, and they just never really passed it off to full-blown token holder decentralization. They said, why would we have to? We have this foundation set up. It works. If it ain't broke, don't fix it. And the further we got into an SEC that just called everything a crypto security without explanation, the more people were just comfortable sitting in this middle ground phase. And we just started to see the desire to fully decentralize, to really treat it appropriately, moved farther and farther back. Now, I participated in one that I really liked called Hopper, Hopr. It's a privacy VPN kind of connector for blockchains. And they started with the foundation. They raised the capital. And straight out of the gate, even to launch the public sale, they put it to a decentralized vote. So they trusted the decentralized ethos right from the get-go. It's something that I think is probably the correct way to go. But at the same time, if their token holders had voted not to do a public sale, right, to raise that last bit of money that they needed to pay exchanges, to pay market makers, well, those token holders could have said no and they would have been stuck. Now, why would they? It was to everyone's benefit, but there's a lot of risk involved in basically building a company and giving away your baby. This is how I like to look at it. And once founders realized that they didn't really have to make that final step, that the SEC was not going to reward them for giving up this power, and in fact, it might even punish them for that, they just got fat on the foundation. And they sat here And it really created a lot of bloat around the industry. It obviously justified higher VC checks, which I've complained about a lot, pushing the value of these companies up higher because they needed to spend more on these crazy operational tasks. Now, as we come back to the A16 article, we are looking at the new market structures bill as a better, simpler alternative, which is that companies can sit at the foundation of these DAOs where foundations could not. One of the biggest problem with a foundation versus a company, it is a nonprofit org. They can operate indefinitely, just losing money along the way. The way they would do this in crypto is by selling tokens. The foundation usually has a treasury. A treasury should be used to reward token holders, but it could also just be a slow drip to pay for these foundational obligations, whether that be the salary of the foundation head or the legal cost of keeping them open. They also have, as a nonprofit, no real recompense for any sort of malfeasance. You can't go after them. There's no legal liabilities. A company has a legal liability. Now, one of the problems with a company is a company tends to operate on equity, and tokens do not. So we do have to be careful that value really flows to one place or the other. Ideally, that would be towards the token, but we can see with Uniswap, which has Uniswap's lab, really receiving all of the trading fees that happen on the Uniswap product. That does not go back to Uni token holders. That goes to Uniswap Labs equity holders. And that's problematic, but that's something that we will figure out. Now, the other big issue is that these foundations and all of the structures, they're nonprofits. They cannot seek a for-profit model. So everything relies on sort of sucking from the teat of the protocol or the app or the product. If it generates a lot of money, cool. But if it's something that relies on inflation to bootstrap, like tokens really do on L1s, that is not great. That's more built-in sell-side pressure. And this is frustrating. This is something we want to liberate ourselves from. Companies, however, are able to pursue profit. They could maybe build a company around, let's say, Ethereum that generates revenue and can be used to support the Ethereum protocol itself. These are all really interesting ideas. They will take some time to build out. Now, at the end, they kind of give us a bullish take on what we can expect to see should the market structure bill pass, and should it give us these opportunities to keep these companies in the US and to operate decentralized blockchains from them. One is a public benefit corporation. Developer companies can incorporate or convert to a PBC, which embed a dual mandate to generate profit while pursuing a specific public benefit. This is good. This means the company can self-sustain itself while also supporting a crypto company. Network revenue sharing. I mean, this is the holy grail, in my opinion, which is that the network shares revenue, and part of that revenue sharing will be set aside for developers, for the DAO, for the people that put in the upkeep efforts. And those upkeep efforts can easily be a full-time job. So why not have a network that captures revenue, whether it be from trading fees, liquidations on perps, anything, right? And say, we're going to take some of that revenue, we're going to flow it back to the people that keep it running. In the previous world, this would have broken the securities exemptions and they would have been deemed securities under Gary Gensler. This is the whole point of blockchains, is these autonomous businesses that create revenue and they share it back. They should share it to token holders. They should share it to the network supporters. And this is an awesome thing to see come to term. Now, milestone vesting, I think this makes a lot of sense in my opinion, basically saying that the companies will unlock some of the team tranche tokens that was built in and set aside from the very beginning when they reach certain milestones. In my opinion, all team tokens should really only unlock when the team keys are burned. They should say, hey, we're passing this off to a DAO. The keys that we have to operate the network, to upgrade it, we're burning our own. Any future upgrades need to be made through decentralized consensus. At that moment, the team's token vesting schedule should start. This would prevent things like Movement Labs, who OTC'd the entire team stack just straight out of the gate. They sold all the tokens. I mean, what incentive do you have as a founder if you've already made your exit? Now, there's contractual protections, which is awesome. We do want to see more of that. Programmatic incentivization, right? Like token holders are better when network participants beyond developer companies like client operators who build on top of, extend, or diversify the network, infrastructure partners who help maintain the network, supply demand, market makers, add meaningful depth. They can all be properly incentivized via programmatic distributions. So these are things that would have broken into that securities land under Gensler. He would have said, fuck you. He would have sued you to death. And this is exactly what this technology is built for, to automate this flow of capital in a most autonomous way possible. There's still a lot of people involved, right? We talked about the market makers. We talked about the infrastructure partners. That could be RPC endpoints, the people that relay your wallet's command to the chain itself. That would be people that run nodes as a service. This is all to make it easier on the user-facing side. Now, we have two new models that have come up very recently, Dunas and Borgs from Gabe Shapiro's LexNode. And the Duna is a decentralized, unincorporated nonprofit association that's basically turning a DAO into something that can operate the chain. It's not maximalizing for profit. The Borg is a cybernetic organization, and it is built in the sense that gives you legal liability and responsibilities. And what this means is that Borg tooling can minimize trust assumptions. This is very important to say that we don't have to trust you. We have a legally enforceable contract between the people at the top of the chain and the people at the bottom, enhanced liability protection in case they rug pull you, etc., and tax efficient structuring. Remember how I talked about a lot of that Cayman company was about tax efficiency, right? How do you mint the tokens? What has to pay for them when they're minted? How do you deal with, like, if you mint them at price X and they launch at price Y, what is that capital gains? How do you deal with it all? These are all really frustrating and annoying things if you're a tech developer and you just want to launch some cool technology. So we're getting really ahead of the curve. This is all talking about how we are kind of crossing that Rubicon now that the SEC is open to building the foundation that I've been talking about for real companies. Not only can we build real companies, but we'll be able to do them cheaper. They'll be more efficient to operate and to run, and they'll have better liabilities for everyone involved. Not only that, there'll be some sort of profit margin in them for it. We don't want these foundations full of lazy fat cat bureaucrats. That is the entire idea that Bitcoin was trying to break away from. So how did we get stuck in these Cayman entities with these dudes out there making, six-figure salaries for basically twiddling their thumbs and chewing bubblegum? We don't want that. We want these foundations to hire the best talent, to give the best upgrades to these networks, and to seek profitability without getting crushed. So I know maybe not the most exciting topic for people that are just investing in tokens, but for those who have built, for those who have gone through the process of laying this whole thing out and the crazy, crazy costs that come with hiring lawyers. I mean, lawyers have sucked up most of that VC funding that we see in the space. And if you want to wonder why we got to this broken market structure where the VCs pump these prices so high, where the valuations of these companies list on day one with perpetuals so that people can short against them, and so that every new token holder is really being placed as exit liquidity over anything else. We're not seeing the value creation of 2017. It's largely here. It's largely in the structuring of these orgs, the immense cost to lawyers to set these up, and just the confusion around what is the best way to do this. This is actually, while I have this sort of diorama here, it changes with the greatest of frequency with the laws of BVI, with the laws of Cayman, with the laws of Zug in Switzerland, with the laws of Panama. I mean, it's nuts. So to return to grace, to get back to nice decentralized companies that can build really robust, strong networks, we are moving in the right directions, and it's a very exciting time. With that being said, do take a moment to read the A16Z article. It will take you about 5 minutes. It's really enlightening, and it has some really deep resources for the curious mind. So guys, stay safe out there. I will see you tomorrow, and have a great day.